I am thrilled. I am absolutely thrilled to be here with you. Where else would I rather be right now than hanging with you guys and talking about all these Wall Street winners that we've got? It's just awesome. And what could be more thrilling than this disclaimer? Really, unbelievable. Wow. All right, everybody, we've got a really interesting but kind of a little bit shaky week here. A couple things going on here. First of all, you can see we're in the midst of a little bit of a dip. No big deal. This is very normal price behavior. And the interesting thing is that the purple predictor is just actually made higher highs on Friday. Price action did not. That divergence is usually resolved in the direction of the purple predictor. So that's bullish. But the indexes themselves are really, really diverging a lot. S&P is kind of the middle case here. So here, dip in the midst of a sluggish bull market. The Dow, on the other hand, is getting hit quite hard. Upper right-hand corner, you can see the little red line representing selling pressure is significantly higher than the green line, which represents buying pressure. And the reason is because the trade war talk really affects big multinational companies, of which the Dow stocks, all of them fit into that category. And it's the big multinationals that are hit by trade wars. Small cap companies, such as are more in the NASDAQ or the Russell 2000, small companies don't export. They don't really import. They're pretty much focused on domestic markets. And as a result, they're not being affected at all. So as we go through these big indices, notice the huge divergence, okay? Dow is the worst. S&P is hit the second. NASDAQ, not really hit. We haven't really sold off here at all. We've gone sideways because NASDAQ technology stocks, yes, some big ones like obviously Microsoft and Google make a lot of money overseas, but most tech companies are domestically oriented, only for the U.S. market, maybe a little bit into Canada, but basically they're domestically oriented. Now on the NASDAQ, the thing that bothered me on this chart was the collapse on the purple predictor, suggesting that the smart money is bailing out of those tech stocks and looking to go somewhere else. I wonder where that could be. Hang on and I'll answer that question. Now, the seasonality indicator we use is based on the Russell 2000. And you can see it made new all-time highs on Wednesday. So that's pretty spectacular. Do you see what I'm saying? So the smaller the cap, the more bullish it is. Fully paid up members know that I mainly focus on mid-cap stocks, sometimes large cap, sometimes small cap, but generally mid-cap companies in our portfolio, which over the last month or so has done fantastic. This week a little rocky, but most weeks has done extraordinarily well because it mimics more the Russell 2000 because the companies are domestically oriented. So this is how the trade talk, the beginning of a trade war is affecting these markets. Seasonality, we should be drifting lower, yet we've been drifting higher. That's actually very bullish. Yield curve, not really a factor right now. It's going to be sideways for a while. Now, this is more important. Asset allocation. You see, the asset allocation is saying, are they putting money into bonds or are they putting it into stocks? Well, when this indicator is going down, it means that money is flowing out of the stock market and into the bond market. And so you can see that's exactly what's happened. Now, this is what I think is happening is we're seeing money flow out of big cap stocks into safe havens, utilities, consumer staples. These are places where people can hide out. They can be fully invested, which they have to be under their pension fund or mutual fund requirements. But at the same time, they can sit back and say, well, okay, fine, I'll just... I don't really need to, I need to be 100% invested in stocks, but I'm going to buy some really boring stocks so I don't get hurt if the market goes down, and goes down because of a trade war. So this is really an important consideration. So they're also going into bonds as a safe haven. A little bit, not a lot, but a little bit. Here you can see after having a huge run where they were saying, give me more risk, you can see they're hunkering down now. They're saying, you know what? I don't really want to be in risky stocks anymore. I want to be in boring stocks. Do you see how everything is changing now? It's these deep insights that you are involved in this particular publication here, this podcast, this video newsletter, whatever you want to call it, because I'm showing you what's really going on. This is not what's published in the newspaper, but I'm showing you the facts. I'm showing you what they mean. I'm showing you the deep underlying patterns of what's driving this market. This is very incredible. Okay, global shares, of course, they're hit much more by a trade war than the United States. Why? Because other countries need the United States. They export huge amounts to the United States. The United States, if they didn't exist, we wouldn't know. Because only about 15, 16, 17% of the U.S. economy is foreign trade, whereas countries like Germany, it's 50%. So trade wars are affecting foreign companies far more than American companies, which we've got 330 million people to sell to. We've got all the natural resources. It's like, really, we don't really need the rest of the world. But the rest of the world needs American consumers. That's why we have trade deficits, because they're selling a lot more stuff to us. So trade wars punish foreigners far more than Americans, and that's why foreign stocks are suffering more. Now, the bond market, I said, was, we saw money starting to flow out. Now, this chart is boring. I mean, this is choppy, sloppy, sideways. This is this chart, just from a purely technical point of view, is a mess. I don't want to trade it, don't want to have anything to do with it. But I already showed you that money is starting to flow into the bond market. Look at our indicators. All of them are suggesting lower interest rates, higher bond prices. The gold line is gold. The blue line is 10-year treasuries in Germany. The chart itself is the CRB, which is a leading indicator of inflation. So it looks to me like, let's go back to the chart. We're about to break out of the highs we made a month ago at just over 122. That's what this is telling me. And if that happens, I got to be thinking about getting long bonds. But for now, I'll wait until we get technical confirmation of what appears to be a fundamental underlying situation. Now, if interest rates are going to go lower, then the dollar should be higher, but whoa. I'm sorry, the dollar should be lower, and look what happened on Friday. A key reversal, a giant topping formation. I think combined with our fundamental opinion on lower interest rates, the dollar has peaked. This rally that I told you about, that I got you long for, I think it's over now. And I think that we're going to probably head back down to at least 93.50 on the dollar index, and then we're going to break that low that we made a week and a half ago at 92.75. So I think the next big move is on the downside for the dollar. Well, if the dollar is going to go down, then that means gold's going to go up. Oh, wait a minute. What's happening here? This is what I've been talking about. Why didn't gold do better than this? I keep saying, with all the bullish news, why isn't gold going up? Why isn't gold going up? It really could never get above the 1305, 1310 resistance area. I mean, yes, it did a couple times, but it never really stayed above there. It couldn't mount a sustained attack, and now it's collapsing. This is very bearish price action for gold, and really, you can't be long gold right now, that's for sure. You got to be short. And our indicators, though, all turned up a little bit. So we got our indicators turned up a little bit, not a lot, but a little bit. Yet the price action was abysmal. We need a week to shake this out, to see which is more important, these indicators or the price action. Who dumped gold on Friday? Inquiring minds want to know. At the same time, we see crude oil skyrocketing on heavy volume. That should be bullish for gold, but it wasn't. So what's happening? Well, we're on an emotional roller coaster here with West Texas Intermediate crude oil. And what we're seeing is that we're seeing the Saudis and the Russians, we're going to increase our production. No, we're not going to. Oh, yes, we are. It's like, yeah, I want to date you. No, I'm just not into you. Okay, let's go on another date. We did have some good times. It's an emotional roller coaster. Right now, they say they're going to cut production. That's what they said on Friday. So the market rallied sharply. All right, I'm going to stand aside here. All right, Bitcoin, also very interesting. I thought that the purple predictor would keep us in a trading range, maybe get up to the top, up to about 9,000. And instead, we broke to new lows. Now, I had a short-term position or opinion that we would rally a bit. Not a lot, not a big bull market. We'd stay in that band, that blue band that we're in. But I also told you that my long-term opinion of Bitcoin was that it would drop to below $5,000 and maybe as low as $4,000. The reason is that everything that has a cost of production has to, on occasion, go below the cost of production. Well, why is that? Well, if I've got corn and we produce too much corn, then the price of corn will go down to below the cost of production of corn so that farmers won't grow as much corn next year, thus choking off supply, thus causing a new bull market. Now, there's a lot of variability in the cost of production of Bitcoin. The best estimate is probably about $5,000. There's some places where it's cheaper and some places where it costs more, but you have to worry about electricity, cooling, these kinds of things in order to produce Bitcoin. So what's going to happen is we've got to get down below that $5,000 level. And remember, the $5,000 level is with a lot of variability. Could go as low as $4,000, maybe even $3,500. But anyway, we're going to go below $5,000. And the reason is we've got to get Bitcoin down to a price where it chokes off supply and causes Bitcoin miners to stop mining Bitcoins. And once they stop doing that, then we'll start to get another bull market that can get us up to new highs, maybe even new all-time highs. But Bitcoin has stopped being a mania. It's stopped being a faux currency. Now it's acting like just any other commodity. And so the mania is over. Now we can trade it like anything else. All right, everybody, got a few confirmed events coming up. June 30th, our Wealth Builder Virtual Summit. This is an absolutely free event. We've got some innovative things. I'll be teaching a couple of hours. We've also got Ian Cooper. He's going to be talking about biotech stocks. He's going to be talking about marijuana stocks. And we also have Abe Kofnes talking about a new way to look at sentiment in the Forex market. So we've got several innovative topics there. I'm going to be talking about the outlook for the market going forward for the rest of the year, and I'm going to be talking about some actual trading techniques which I'm going to reveal to you during this particular virtual summit. So it's basically a webinar. It's also free. Be sure to look in your emails for registration information. Then, following up, Abe is going to be doing his August 11th and 12th Forex Wave Rider. That's the name of his technique, where he uses sentiment in an innovative way. That's going to be fantastically interesting because it's totally innovative. And then I'm going to be giving in October a Futures and Forex Masterclass in Dubai. So I know you should all, of course, book your plane tickets right now. All right, everybody. I love having you here, freebies. All you fully paid up members, though, we got some cool stuff coming up here. Some new trades, too.